What's going on, traders? Thanks for tuning in today's YouTube video. My name is Darius, and in this video I would like to show you how to become a better trader. So this is a new series that I started where I will release now almost every week a new tip and trick about how to improve your trading skills and a lot of more education. Now in this video I would like to talk about pin bars and why the pin bars do not work like we do expect them to work. So I already covered up that topic on TradingView, and I decided to make a new video over here on YouTube so that everybody can definitely watch this multiple times and to be a better trader at the end of the day. So guys, before I would like to start off with this video, just a quick check over here. I got a forex account which is copy fix. So if you're struggling with trading, you can simply just copy paste my trades, and in this account this is a long-term one where I hold my swing trades, I scale in my swing trades. Basically I'm trading over here the weaknesses of the dollar, so I go long on euro, I go long on gold, I go long on GBP/USD, AUD/USD, and so on. So if you would like to take advantage of this one, then make sure to check out this link. And also if you are interested in just copy paste my trades, so I also do normal trades with a 1 to 3 risk reward at least. This is how I plan my setups, sometimes even higher, like a 1 to 5 or something like that. And this is my past results, so I got in the last 3 months plus 65R. You can check out the results also on Instagram or on my Telegram channel. Okay guys, without further ado, I would like to get straight into the topic, and like I told you, it is about the pin bars. Now, we got over here 2 examples. The first one is going to be one which is the wrong expectation, and the second one is going to be how it will really work. Okay, now we all know about support resistance, right? And everybody's telling you when you are at a level of resistance. So this example is right now based on resistance, but it works exactly the same for the support, it's just vice versa. And the thing is, the plan is behind the support resistance strategies that you should sell at resistance. Okay, but every trader is telling you, okay, whenever it is the market is approaching that level, you should wait for the market to give you within this area some price action confirmation. Now, one of the most popular price action confirmations are the pin bars. Okay, the pin bars like this, bearish pin bar, and they do expect that the market then will completely reverse from that level. Okay, now I'm here to tell you that this is not really the truth. It will not really work like you expect it to work. That's the truth behind the pin bar, because I'm trading right now almost 2 years non-stop, and also me at the beginning of my trading career, I was just looking at those pin bar techniques, at the support resistance, and when I heard the first time about it, I just thought, oh my god, I got the gold ticket in the forex trading market and nobody can stop me. But the fact is, so the real facts are that I was just constantly losing my money because I was relying on that strategy. Now, don't get me wrong, it doesn't mean that this strategy doesn't work. Of course it works, but not that good. So your risk reward is not that high. So you need to build a own strategy where you really can work with those pin bars based on support resistance. I use them a little bit different, okay? But in this video, I would like to show you that it doesn't really work when you use it as support resistance. Now, imagine over here in this scenario, the market is moving to the upside, and then at a level of resistance, you're looking for the price to go to the downside. You get that pin bar over here, and you're going to place your trade just up here, and the market will then go to the downside. So I'm putting over here the thing. This is your stop loss. You're putting it always above that wick. That is the idea behind the pin bar. Now let me just do this one red, so that we are going to clarify this one as an pin bar, as a stop loss. So this is my stop loss. Great. Now this is your expectation. The market should go then from here to the downside. Your entry is at this area, okay? So this is your stop loss range, and that's going to be your take profit around that area, okay? And then you're going to have a nice risk reward. Okay, that's the idea. Now, the thing is, maybe you already noticed it, that most of the times it will not happen like that. Most of the times it will happen something like this. So the market will really reverse at that area. But the fact is that exactly over here, all retail traders do have their stop loss. And what does stop loss mean in the market? Right, it means liquidity. So you have over here a stop loss, and stop loss is always a liquidity. Now, this is why the market will always move to the upside, hitting all those stop losses, because the market always knows where they are located, okay? So the hedge funds, they're only going to be given the liquidity for their orders only if they're going to hunt your stop losses, okay? That's always how it works. And in this kind of a scenario, you will be hit the stop loss from the sellers and also from the buyers. Why? Because at this price over here, you're going to go for a short, right? Then the market will go to the upside, hitting your stop loss. Then, during the movement to the downside, what will happen? The breakout traders will look over here to buy it, and they will buy over here for the potential move to the upside. And the thing is that this market will move all the way to the downside, hitting also the stop loss from the buyers. And this is why this forex trading market is sometimes that hard, because it will trigger both sides. Okay, maybe you've decided the right decision to do, so in this case to go short was definitely the right decision, but the fact is that your stop loss and your entry was not right, okay? The thing is, within a resistance area, the market is kind of providing you the good opportunity. So it looks super nice, okay? It looks super obvious, okay, that the market should go down from that level of resistance, okay? Everybody is looking, okay, where resistance, the market needs to go down. And there's nothing wrong with that decision that the market should go down. But the thing is, what most of the traders are, they are not patient. So they don't like to wait for the market to go a little bit higher and afterwards to go for that short. So they will immediately execute their orders over here. And the idea of them is that they're going to use sometimes large stop losses. And in this case, if you would have used a larger stop loss like this, you would have been safe. But what is if this market will not potentially go in that direction? What is if in this case the market will go like this? Okay, then you will lose much more money, okay? And also your risk reward will be much more worse, okay? And that's the thing. This is why these potential areas over here, a little bit above, are not interested for retail traders, but hedge funds are interested in those kind of particular levels, okay? Always levels where where the most retail traders do not even think of that could be a potential entry. And this is my solution, guys. So this is the scenario which you should do. This is what you should not do, because stop losses are liquidity. And the idea of how to trade this one correctly is like this. This is how I do it. I place my sell limit orders exactly at those levels where all the retail traders are putting their stop loss. So that's kind of the exact opposite. So I'm just showing you over here in this video kind of how you should rethink everything, okay? You should just be aware of this stuff, okay? Because everybody knows this strategy. Everybody knows that Pinbar. But do you know that one over here? Do you know that kind of potential of a stop hunting attempt, and then you're going to get that sniper entry, and then you're going to go to the downside? Have you ever wondered about how to get those sniper entries? That's how you're going to do this. Do exact the opposite what most of the retail traders are going to do, and you're going to be that one who has the biggest bags in this market, guys. This is how it really works. And right now I would like to also show you a nice example how this looks in the praxis, how it looks on a clean chart, and we're going to just scroll a little bit above, having a look on the Euro USD, because here we have a beautiful example, exactly what I explained over here. Now look at this chart from the 4 hours. You will identify over here a pretty nice support resistance level. Okay, this is a normal retail trader support resistance. I'm going to map out this one in black, and look over here. That's going to be your potential trade, because you're looking over here. Okay, you see support level. So let me just do here this back testing tool, showing you like this. So you will think of this is a support level, this is a resistance, support, resistance. Okay, and the idea is currently when the market will came back to this level, the idea will be, okay, let's have a look to short this market. Okay, now in this case you didn't have any proper price action confirmation from a 4-hour perspective. Okay, in this case here you wouldn't have got a nice entry, but here you're looking and you see over here, okay, first Pinbar, market is moving to the downside. That would have been for you the first probability, okay, to put your stop loss exactly around that area based on this Pinbar. Now what you can also do is that you should put your stop loss above this Pinbar over here. So as you can see, the market has offered you again a new price action confirmation exactly at the resistance, and you do expect right now the market to go to the downside. Okay, so let me now just a little bit delete those things over here, and exactly based on this example you can see how you can really enter this market the right way. Okay, so to do the right decision in this case. So you have a look at this Pinbar. You're going to put your stop loss here above that area, and what you can see is when you're going to hit the play bottom is the market will hit your stop loss and then it will go without you to the downside. Okay, as you can see, this is the exact thing which I explained to you before. The market will always go to the upside, hunting their stop losses, and in this case, look at this, the market really moved crazy to the upside. Look at that one. It went from here to the upside and then it dropped to the downside. So this is simply just a fake out in this case, okay? And fake outs are grab of liquidities, always and always and always. In this case over here, the market really respected that area and it went a little bit to the downside. But this is not kind of your risk reward that you're looking for, right? Your stop loss will be here again a little bit higher, okay, like this, and maybe your risk reward wouldn't be that good. Plus your entry would have been around that area or something like this, and this was just a small movement and you were expecting after this impulse a correction and then a continuation to the downside. And what really happened is that the market went a little bit higher to grab all the liquidity, and in this case they faked out with the movement to the downside. So a lot of traders entered here, here and here because they've seen the market moving to the downside, and this is why the market then went even higher to hunt more stop losses, giving you here another signal of a Pinbar that you should definitely look for a nice short. Okay, in short in this case is, like I explained to you, not the wrong decision, it is the right one, but your setup is not the right one. And here's the solution, guys. The solution would have been very simple, just supply demand. Okay, look over here, fresh level of supply, and as you can see, the supply would have been your solution. The market immediately dropped crazy to the downside after grabbing the liquidity from here, going all the way to the downside. And this is how your setup should really look like. This is how I do it. Okay, this is how I protect myself from stop hunting. And look over here, you can use pretty tight stop losses like 20 pips or less. This is what I use. I use between 10 and 20 pips. That's the most stop losses that I use. Only if you're doing some swing trades, then you can use much higher stop losses. But in this case, look at this, a risk reward of 1 to 7 would be over here more than enough. Over here you got here the next level of demand. From here you could have looking for potential reversal. Let's see, and exactly this is what happened. The market from here is going again to the upside, and what here again retail traders would have done is putting your entry around that level of support resistance, and again fake out, boom, and then the market is moving to the upside. Okay, now don't get me wrong, right now with this video I don't want to say to you that support resistance is not working. It is just my personal opinion that it doesn't work from my point of view. Maybe you have a different price action confirmation around that support resistance levels. mine is the supply demand. This is my solution, how to prevent those fake moves. And the thing is that I would like to jump with those fake moves. Okay, so this is the idea behind this video, is just for you to think a little bit different, okay, to keep in mind that this over here really exists. So stop hunting is actually why the market is moving. So this is just manipulation, and the whole forex market is super manipulated. And this is my solution. My solution is to put your entry exactly there where most of the traders are putting their stop losses. Okay, guys, thank you for this for your attention, and that was that video. See you then next time with a new one. Bye bye, guys.